the Fed? Will they ruin the rally, and what trades look good ahead of the event? Let's get in the money right now and find out. Mike, what do you say?
You know, I hear everybody saying they're not going to raise and they're never going to raise, not in September, not in December. A 25 basis point raise is really not that meaningful. I mean, we were talking about it before the show. I don't even imagine that it's going to change the long end of the curve all that much, honestly. So I think there might be a couple members over there saying to themselves, maybe this is our one chance, and it's not going to hurt things that much.
Not a shot. I mean, when you think about one of the tools in the Fed's arsenal, it is to surprise markets, and they do it when they want to ease monetary policy. On the upside, they do not do it. There's no point. You know, I agree with you that a 25 basis point move, which would only be the second in 10 years, Mike, may not be that big of a deal.
Liquidity is also global, though, and every other, you know, they have a license in some position because there's basically capital being provided everywhere else.
When we're all in it, here we are, we're in it. The market just closed. Monday we'll be in it. When we step back at some point, 10 years, 20 years, think about people talking about birds. We're talking about doves. We're talking about hawks. What is it really about? These are turkeys. I mean, these are grown men and women, and they're going to look back and say, there they were for a decade, and they couldn't even screw up the courage to put 25 basis points on the cost of money. I mean, it's absurd.
Yeah, but if
the market's hanging on its every word.
If they haven't done it for the entirety of 2016, the idea that an apolitical Fed, would do it, you know, ahead of this election makes no sense. They do not want to be on the hook for letting a maniac into the Oval Office, in my opinion. And that's what could happen if they did get really hawkish, in my opinion.
Fact of the matter is, seeing the forest of the trees is fine and all, except that we are seeing essentially a taper tantrum whenever the idea is floated that the Fed could actually raise rates in September.
That's the absurdity.
Markets freak out. And so that is the absurdity that we have to live with.
They're freaking out for two reasons. I mean, but the other reason is also valuations. I mean, this is an epic set of valuations for bonds. This is pretty heady valuations for stocks, and not a lot of economic justification for it. So they're going to freak out about anything. You know, I mean, they're going to hear the door close too loud behind them. They're going to run out of stocks. I mean, it has nothing to do with the Fed. It has everything to do with valuations and economic justifications for owning them.
Yeah, but that's a really important point. If they were to hike into a weakening economy, we just had this really bad ISM data. We had this miss in the August jobs data. I don't think they're going in September. I don't think they're going in Nov. I think December is 50-50. And if we get some misses on non-farm payroll for September and August, then December's off the table. And that's why I think you want to look back at bond proxies again.
So utilities.
Oh, yeah. You want to do utilities?
Yeah, let's do it.
So let's look at the XLU. That is the ETF that tracks the utilities sector. It's down about 7.5% from those 52-week highs that it made in early July. I think it sets up really interestingly into the end of the year. I think December is obviously on the table. If for any reason the economic data doesn't support it, then you want to be in sectors like utilities. So today, when the XLU was trading at $49, you could look out to December expiration. You could buy the 49.54 call spread, paying $1.50 for that, buying one of the December 49 calls for $1.65, selling one of the December 54 calls at 15 cents. $1.50 is your max risk. That's 3% of the underlying ETF price. And my trade here is really to get it back up to those prior highs and possibly get a bit of a breakout. If they don't raise in December, this thing's going there.
Well, I would certainly rather be long utilities than long bonds at this point. And actually, I don't dislike all the bond proxies. I mean, that was kind of the thesis behind Verizon, a trade I'm sticking with, by the way, for similar reasons. And also, a lot of these things have already, you know, they've been a little bit hurt. So this is one of those situations. Also, just to keep this in mind, 10 years from now, utility rates are going to be higher. So you actually have a little bit of an inflation adjustment component that goes into something like utilities that you don't get if you buy bonds.
I have a question, though. You know, whatever the Fed does, what we've seen this week is at the long end of the curve, the yield is going higher. So in that scenario, do you still want to be in these bond proxies?
Well, there is some, if this is all a sort of a forward-looking and discounting mechanism, there is quite a bit of possibility that were they to do that, the long end is priced a good piece of, or if not all of, this huge 25 basis points in. So that's the issue.
Isn't a piece of the fact, though, that we've seen that long end going up, though, the fact that we saw somewhat higher than expected inflation data? Aren't utility rates impacted? I mean, they basically track up with inflation. Yeah. So the inflation component is going to affect this sector as much as it is U.S. Treasuries.
Right, but I also think that, let's just say that we do have a scenario where people are looking for defensive, they're looking for yield, there's a lot of uncertainty about the economic data. I think that utilities also work in that environment too. So, and I agree with you guys as far as rates. They've already moved up from that epic low in July, and therefore they may be incorporating any sort of increase. So I think this trade probably works okay under most scenarios.